Okay. We will talk now with John Hoagland, Director of Trade Development of Topsteptrader, right?
Yes, that's me.
All right, John. You have been able to watch trading performance of many traders. So can you say that they have something in common? Especially I'm talking about those who were able to survive in the long run, live traders.
Well, there's a lot of different time frames. There's a lot of different strategies. There's a lot of different tools that different people are using. But the one thing that I can say is common to all of them is patience and risk control. The traders that are focusing on looking for the right opportunities, little risk, big reward. They're not focusing on being right more often. They're focusing on being more right when they're right than when they're wrong. So that's that asymmetric opportunity, little risk, big reward.
What about scalpers?
Scalpers
they can afford big reward, right?
If you take a look at scalpers, it's a very short time frame, and most of the time their risk to reward is going to be 1-to-1. So they're counting on being right a lot.
Yes.
And that is a difficult feat. If you have to be right 70% of the time to make any money, you've got a lot of effort put on you. Yes, a lot of pressure.
Okay, then the next question is, every trader in his career has to change or to improve his trading. Most of traders, they have some issues to work on. Definitely some may move stops, or some has to work on his risk management. So can you say that, so have you seen such cases in your career as a trading coach maybe? So out there are traders that can improve such ways, that can change.
I see people improving and changing all the time.
All the time.
All the time. They may start, everybody starts not knowing pretty much anything. They may think that they know, but they don't know what they don't know. So everybody starts as an unconscious incompetent. You get into something, you say, well, this is easy. All I have to do is click here and click here. I buy, I sell. I can make money doing this. They don't realize how difficult it truly is to understand the market and understand themselves. So when they finally realize that, I really don't know what I'm doing here, they're a conscious incompetent. Now they know, God, this is a lot more than I thought it was going to be, and I've got a lot to learn. So that is the point where they can begin to read. If they're going to self-mentor, they're going to do a lot of reading. They're going to have to do a lot of screen time on simulators, and they're going to have to begin to learn about who they might be as a trader. Different time frames, different strategies, different tools.
Maybe they become more humble in their expectations.
That's one of the things, and we do see a lot of people come in and they think they know what they are going to be able to do, and they think, well, we don't know anything. They know what they're doing, so that's all they need to know, and it's not too long before they realize, maybe we're not so dumb, and they've got a lot to learn. Now, I've been at this for 32 years, and there's a lot that I still have to learn. There's a lot I don't know. There's a lot I don't use. There's a lot I've learned that I've kind of discarded because I've learned what works for me. So if you're self-coaching, or even if you're coaching, it takes a lot of work. So you go from unconscious incompetent to conscious incompetent, and there's a long road before you get to a conscious competent. Okay, now you're consistently making a little bit of money. You're making fewer mistakes, but it takes great effort and concentration for you to remember all the things that you have to remember that are going to keep you out of trouble. One of the most important things that I can say, if you have a mentor, if you're self-mentoring, it doesn't matter. You have to journal. And I'm not saying I bought it at 70 and I sold it at even, and this was the signal that
It's just the stats, right? So
that's just a log. That's just writing down the facts of the trade. The journal is how you felt, what you were feeling physically, mentally, emotionally, getting into the trade, while you're in the trade, getting out of the trade. And then you have to take that journal and line it up with the log and think about what was going on in the market at that time. What was your signal? What were you feeling? Was it a hard trade to take? Was it an easy trade to take? I find that if it's a difficult trade for me to take, it's probably a good trade. I'm kind of the opposite emotionally. The really good trades are the hardest to take. The worst trades are the sure things. Oh, this is easy. I know this. I'm going to take this.
I'll just push the button and
Right.
make money, right?
Right. But those are the ones that maybe a lot of people are seeing and for that reason are not going to work out. So if you're noticing, this was a really hard trade to take and it ended up being a good trade, the next time you see that situation and you feel that same way, it's going to come to you faster that, wait a minute, these are the trades that I really need to take because they're the harder ones to take, but they've proven to me emotionally in every way that these are the good trades. The harder trades to take for me are the better trades. If it's like, oh, this is just a layup, then I'm probably going to lose.
Great thing. John, can you say that trading has become more difficult in whole within the period of maybe the last 5 years or 5 to 10 years because a lot of algorithms, mechanical algorithms that are operating in the market. So can you say that now for the beginner trader who is coming to the market right now, it is harder to start than for those who were entering maybe 5 or 10 years ago?
Well, other than the fact that the pits are gone, the pits were a whole other story. That was, it's very different now on screen than it was in the pit. When electronic trading first started kind of overtaking the pit as far as the volume was concerned, and there was good participation, the volume was increasing, and the algos and the HFTs weren't around yet. There were a lot of people that came from the floor who were trading very fast strategies, in, out, in, out, in, out, in, out, in, out, and they were very successful at it. But when the machines came, they took that away from them. So the true scalper is a machine now. Okay, so that's one way that it's a lot more difficult for a scalper than it was back then.
You advise to avoid scalping or such very fast trading styles.
Well, the fast trading style, the scalper, the true scalper is the way I know them, is gone. If you're not, if you don't have a couple of MIT grads putting together your strategies for a high frequency trading, then you shouldn't be a scalper.
All right.
Okay. Now scalping is a relative term. If there's somebody in our program that I would consider a scalper, it's that 1-to-1 risk reward looking to be right 70% of the time, 80% of the time.
Let's say this trader can be a very short-term trader.
Very short-term trader.
All right.
Right. Not a scalper the way I knew it.
All right.
And, to go back to your last question is it was very difficult to become a trader before on the floor. We had to have $50,000 in a T-bill put up with the clearing firm. And then you had to have money to trade over and above that. You had a seat lease that you were going to, pay anywhere from $500 to $3,000 a month for. So the barrier to get into trading on the floor was very difficult. You might be able to get to open an account and trade from off the floor, but then you were like everybody else. There was an advantage to being on the floor. Now, everybody's on the same page. So now it's all up to recognizing the right opportunities and being there to take advantage of them.
Okay, that's understandable. What can you advise to beginner trader? What to start with, in terms of education? Because there is tons of information over there in the web, many theories, many trading methods, strategies, and beginner traders, they feel confused all about that.
And I can imagine it's, I'm confused half the time.
Yeah, so what would you advise maybe to filter or maybe to focus on?
Okay. All right, I see what you're saying. If you are new to futures trading or any type of non-investment type trading, you have to begin to understand how markets work. Markets are auctions. The market is going to rally until prices are perceived too high by the majority of the traders. Buyers will then back off, sellers will come in. The auction to the upside is now over, and a new auction below to the downside begins.
So that's market auction theory, right?
This is, yes.
So market auction theory, can you advise to learn order flow techniques, to read order flow, depth of market?
Absolutely. No, I think that the participation that you're witnessing in the market at any given time is one of the first things that you have to look at before you take a trade.
Well, what about all those automatic trading? Because if you see the futures depth of market, it can be also confusing. So you see some volume stepping in, then it is absorbed absolutely, so nothing happens, no continuation. So and such volumes, they can step in and step out all the time. Mm-hmm. So what about this?
The consistent absorption of one side of the market or the other is typically a longer time frame or another time frame participant executing.
So we have to look at it in a larger context. So
yes.
Look not this single event, but as a series of events.
Yes. Yes. Now, yes, there are HFTs, there are algos that are going to spoof the market. They're going to make the market look heavy just by putting offers above the market and then canceling them if it gets there. You have to witness what's actually trading.
All right, so we have to observe, to look, and to make conclusions. Observe a series of events, looking at the bid-ask spread, looking what's happening with the order flow.
Mm-hmm.
All right, John.
And even more importantly than that is what's going on in the longer time frame. If you're not watching open interest, let's say, open interest and volume are the volume is the power behind a move.
You mean commitment of traders?
Commitment of traders. That's every week, but every day, the CME puts out a bulletin that points out the open interest. Now, the open interest is the total number of contracts outstanding. So for every one in open interest, there's a buyer and a seller. So if you have a big day up and there's big volume up and open interest increases substantially, that is new money coming in the long position in that market. It is likely to continue in that direction until volume falls off and you start to see open interest start to fall.
Or at least you don't have to go against this market.
Right. It can, before it shows up in any chart, when there's a change in the market, it's going to occur between volume and open interest.
All right. Well, John, thanks for the answers.
My pleasure.